Hunter, here we are again, another Fed meeting behind us, another quarter point rate cut. And it's been interesting because the Fed has been more live lately, I feel like. I mean, it's a little bit of just discussion within the Fed of whether they're going to cut, whether they're not. And now we're really focused on what's going to happen moving forward.
Yeah, exactly. That's a really interesting point to bring up is that in the past, we've had a really good idea of what the Fed's going to do before they do it. And between last meeting and this meeting, the Fed futures have priced in almost entirely a cut, almost entirely not a cut, and then back somewhere in the middle leading up to this meeting. So this one was definitely all over the place. It didn't help that data flow has been weak, coming off the government shutdown. But this one, and I think going forward, we're going to see a lot more lively discussion, a lot more up in the air, and more decision making going forward.
Exactly. I mean, looking at the Fed expectations, which we're going to get into, it's interesting to see fewer cuts expected for next year compared to this year. So each meeting from here on out really is going to be more live. It looks like January we're probably going to be on pause as far as rate decisions go or rate movement goes. But I think as we get into 2026, it's going to be more of an intense discussion, really following the economic data to determine, hey, does it make sense to cut or doesn't? But taking a step back to this week's decision, it really was, I think it was proper for the Fed to cut rates. They really stressed that they're focused on the labor market. We've talked about this before. They're worried about the labor market worsening, and Fed cuts, lower interest rates, give businesses more freedom of capital in order to make those hiring decisions. So the idea is to help the labor market through that mechanism. And I think that's the more important side of their mandate. I've talked about this on a million podcasts, but the Fed's dual mandate between maximum employment, keeping unemployment low, and then keeping price stability, so making sure inflation is around what they call their 2% target. It's really what they're trying to manage. Right now, they're really more focused on the labor market side of things. And so I think that's why they went forward with this cut.
Yeah, and I think it's easy to kind of look at the stock market and look at some of these mega cap tech companies and wonder how much a cut is really going to help the economy, because market cap wise, it's predominantly large cap tech nowadays. But, hiring and jobs wise, that's the lower, smaller end of the economy. And all of these companies that aren't mega cap tech, that makes a big difference, especially for small, medium-sized businesses, their ability to hire more people and expand. And part of that oftentimes is taking on debt to do so. A lot of that is freed up by lower interest rates. So that really does have a direct impact. I know depending on what you're reading or just depending on the day, I find myself kind of feeling like, oh, how much is this really going to help? Because all of the momentum is in those top names as far as, economic, production. But it's because it's that way that it's the not lower income, but lower scale businesses, your small, medium-sized businesses that aren't producing so much because interest rates have been prohibitive for such a long time.
Yeah, I mean, I think that's a great point. You made a good point. Smaller companies typically have to fund their operations more so on debt. So if all of a sudden, that debt burden is, 75 to 100 grand less per year, that gives them the bandwidth to hire that extra person. And it can be, even greater scale depending on the size of the company. So I think that's a great point. And we've come a long way since, essentially rates peaked in 2022 and then, really maintained that high level through 2023. It was about mid to late 2023 when we last saw the peak of interest rate levels, or at least the Fed funds rate. And that was around the 5.25% to 5.5% range. This most recent cut brings their target range to 3.5 to 3.75. So we've made, almost a full 2 percentage points of rate reductions at this point, which is continuing to trickle into the economy, because it's important to note that all these rate decisions act on a lag, because these companies aren't necessarily borrowing day one as soon as the Fed cuts rates. Of course, anyone with floating rate debt, that is immediately impacted. So you see SOFR, the overnight bank lending rate, it will drop commensurately with that rate cut. Same with a lot of checking or savings rates, your money market rates drop immediately, but it does take time for that to trickle into the economy and also into asset prices as we continue to talk about the stock market, about bonds and other assets which we're investing in.
Yeah, and so kind of moving on from the decision itself, that 25 basis point cut, we also got a new dot plot, and then of course the Fed commentary that came with it. But taking for a minute just the SEP, Summary of Economic Projections, also known as the dot plot, providing that future expectations for interest rates, but also for GDP, inflation, all of that stuff. And those are always very important to look at. Especially coming off of 3 25 basis point cuts in a row. We're not, like you said earlier, not expecting another one in January, but the Fed members are looking at 1, probably 2 more next year.
Yeah, I mean, I think that's where you get into the discussion, the debate of all this and why we're looking at these next few meetings being so live, if you will. Is that there's a wide dispersion as far as what expectations are for how many cuts are going to be next year. There's all the way from actually what would be a quarter point higher, so potentially a rate increase. We don't view that as near the base case. But you've got plenty of members at the 1 rate cut level, at the 2 rate cut level, at the no rate cut level for 2026. So you've got a wide range of opinions or at least outlooks. And I think it's important to just note that that's how reliant the Fed is on economic data right now. They're really watching the labor figures. They're really watching inflation levels, because I don't think many of the members really know at this point, what the actions next year will be. I think they're just saying, hey, this is an estimation, but it's really going to depend on the data on a go-forward basis for us to make these decisions.
Yeah, because at the end of the day, you're asking them to just make a guess 12 months in advance using today's data, which, again, they've been flying a little bit blind for a few months here. Not to say they haven't had any data, but they don't have their normal sources. They're a little less comfortable with it. So, of course, they're going to hedge themselves a little bit more towards the fewer rate cuts. The median dot is at a 1 25 basis point cut next year, but 1 or 2 cuts I think are more or less equally likely where we are.
Yeah, we can get into our base case later, but I think somewhere around that 2 cut range is pretty appropriate, and that's what the market's pricing in right now. Kind of getting back to the Summary of Economic Projections, I thought there were a few notable call-outs from that as well, because the Fed doesn't only forecast expectations for rate cuts. They also, provide GDP, unemployment, and inflation expectations. And I thought a big data point to note was that they did increase GDP for 2026 substantially. They had it at 1.8% for 2026, moved all the way to 2.3%. So you're talking about 0.5% increase in GDP. They are expecting higher economic output, which is very positive for the market overall. It means that we're delaying any type of recession. We're maintaining solid economic performance, and that bodes well just for the health of the American consumer, the health of the economy, and ultimately the health of the stock market. I think the other piece of that is they actually ratcheted down inflation expectations to just 2.4% for 2026, which is within spitting distance of their 2% target. So we were very, very close on that. It reflects that mentality that they're less focused on inflation right now. They're more focused on that labor market piece, which if they believe the labor market is in trouble, they will continue to cut rates.
Yeah, exactly. And it's inflation picture is one of those things where they're looking at it right now as services, mainly housing particularly, has come in a lot. And that's something that we've been waiting to roll over for ages because we've talked before on it, but how it's measured, what the realities we're seeing in the market versus how it shows up in CPI, PPI, or just CPI, I suppose, how that all is really playing through. We've been expecting that to roll roll over and start decreasing for a long time now. And in previous months, it has. What we've seen take up recently are those goods inflation numbers from where they were about zero to some goods being deflationary. Those are back up into the low percent and a half inflation, mainly based on tariffs. And so the Fed's really looking at that, expecting it to be a one-time shift in price level, but not an increase in ongoing inflation. And so that gives them a lot more comfortability and confidence that inflation's on its way down. Even if it looks a little stagnant right now, the underlying dynamics mean that inflation's on a downward trajectory, so they can focus more on the economy.
Right. It's interesting that you're finally seeing the housing figures really roll into the CPI, because you and I have been talking about this for at least a year now, that the housing market, if you're looking at the spot market in the actual economy, prices have decreased. Not only have they stayed flat, they've actually decreased in most metropolitan areas, particularly here in Austin. We've experienced that firsthand. But you see a lot of these inflation indicators that are not attached to the CPI that are showing housing deflation. And so it's only a matter of time before those roll into the CPI. I won't get into the lagged effects. We've talked about that at depth before, but it takes time to filter into the CPI, Consumer Price Index inflation data. And we're finally seeing that. And it has such a large influence on the broader CPI that it's really going to put pressure on it to the downside, which we think is going to give the Fed, more leeway to cut rates, because inflation is not such a barrier. They can protect the labor market more because they feel good about the inflation picture. You mentioned tariff inflation. I think that's a little bit of an offset, but luckily so far we haven't seen dramatic inflation from the sectors that are experiencing tariffs. So that's definitely been a positive.
Yeah, and that's why I mentioned a lot of those sectors have been in deflation leading up to this. And now, that's kind of normalizing inflation to closer to what the Fed would actually want a lot of things to be. Again, after we've seen a big run up in goods inflation and just broad inflation, you don't want to see goods necessarily high. You don't need to see them at 2%, but having them at 1% is probably healthier than having them in deflation. So, some short-term stuff, but, really all shaping up to be good for the inflation picture overall. And kind of turning to the press conference, Jerome Powell really sounded like he was believing that for once. He's been kind of reluctant to give much of an opinion or really kind of show behind the scenes so much as how they're feeling. But I really thought, at least personally, I thought this press conference was a lot more dovish of Powell, a lot more, ease off. He doesn't seem so worried as he seemed in the past.
Yeah, I mean, it's interesting. We've come a long way since Powell said that economy or the markets are going to experience pain from rate increases back in 2022. He really did lean on the dovish side. And when we say dovish, of course, we mean easier monetary policy, lower rates, versus hawkish, which would be, tougher monetary policy, higher rates. But he did really tilt to the dovish side of the spectrum, which I think was a surprise for most of Wall Street. Was kind of expecting a relatively hawkish press conference, but he really put the pressure on the Fed and saying that, hey, we're really focused on the labor market right now. This is where our concern is. We think that inflation is continuing to roll over, which is very, obviously very positive for a number of reasons. But now their mandate really focusing on that labor portion. So they feel like they have leeway to cut rates. I think that's what led to the decision at this most recent meeting. And I think it's going to drive the narrative on a go-forward basis as well. Because, like I said, if you're focusing on the labor market, which is a little bit harder to track necessarily than inflation over time, they're going to keep the onus on that part of the mandate as they make these future decisions. Yeah,
especially because while the Fed remains firm on their 2% goal for inflation, they ask Jerome Powell this every meeting. He says the same thing every meeting, that they are still focused on getting inflation down to 2%. But if they're seeing it at 2.4% next year, well, that's a lot of progress, and that's still a very healthy level, and not something where they're going to force that last 0.5%, which really is just going to take time more than anything that the Fed can do. That last 0.4%, they're not going to force that. Instead, they're going to focus more on the economy and making sure that's in a good spot, because stability in the jobs and the economy, that will allow inflation to come down slowly over time, as opposed to creating an issue over here, which doesn't help the reason that you're trying to bring down inflation in the first place.
Absolutely. And we've mentioned the tariff inflation piece a couple of times, but even Powell reiterated that they expect Q1, Q2 for that to really roll off the data, because tariffs are that one-time price increase to catch up with that tariff rate. And then in theory, they shouldn't be trickling through to the data anymore. Of course, there's some lagged effects with the timing of retailers and when they do those price increases. But in theory, it should be a one-time price increase. The Fed is acknowledging that, which I think is positive, and rightly so. So they're really waiting for, on the inflation side, for that tariff piece to roll off. Like we said, the housing is rolling over already. There were a few other interesting facets to the Fed and their decision, which I think we should walk through. And one of them is the QT, so quantitative tightening, versus QE, quantitative easing process. Hunter, do you want to kind of kick us off on that? Because I think this is a piece that's really has been underreported, but very critical when it comes to markets and liquidity.
It absolutely is. And so, during COVID times, the Fed aggressively grew their balance sheet. And that means that they're buying assets, treasuries and mortgage-backed securities from the open market, putting those dollars into the market to try and help stimulate the economy. That's what's referred to as qualitative easing. QT was coming out of COVID. They started hiking rates and they started shrinking that balance sheet very aggressively. And so that's not only letting things naturally mature, these bonds that come up for maturity, but also selling them into the open market, doing the exact opposite, pulling those dollars out of the markets. And so now we've reached this point where their balance sheet is back down to much more normal levels, and they've actually started not what they're calling QE. It's not qualitative easing necessarily, but they're actually buying some more securities, growing that balance sheet a little on the margins, really just to inject more liquidity into the markets. And that liquidity is something that we've been talking about since the government shutdown, with how that dynamic has really unfolded. And I think this is going to go a long way to more normalizing the liquidity situation. Again, it's not qualitative easing technically, because it's the intent isn't to stimulate the economy. The intent is to fix the liquidity mismatch that we're currently experiencing.
Right. And I think this is a very critical point, because it was the beginning of December 1, when they decided to end the tightening process. So they weren't going to continue letting things roll off the balance sheet. They essentially weren't going to let, money continue to be sucked out of the system. So that was a big positive. Then they announced most recently that they're going to begin this, treasury purchasing era. I don't necessarily want to call it QE, because they don't want to look at it as QE, but functionally it's a little bit the same. So from that, they'll now be purchasing $40 billion a month, particularly in T-bills. And whenever we refer to the liquidity that this provides, most of that ends up in banks, and it gives them, more resources, more capital to eventually lend out to borrowers, which, creates kind of a fresh injection of cash into the economy. We saw some periods most recently where liquidity got tight and banks couldn't lend the way that they really wanted to. And so having this extra liquidity for banks, for overnight lending, so people and banks don't have to tap the Fed's overnight repo facility, it allows, just better health of the broader economy. We saw some trading situations, which we mentioned on our most recent podcast, that was really driven, some negative price action that was really driven by a lack of liquidity. So I think this is very healthy on a go-forward basis, that the Fed is, one, acknowledging this, and two, doing something to help it out.
Yeah, exactly. Because there are a lot of issues that can be created by it. And if you're interested in learning more about that, invite you to just Google up the how the Fed's repo facility and their reverse repo facility, how those interact and how banks tap on them. It's a whole really in-depth situation, but whenever new tools that the Fed creates get used for the first time or in a different way than normal, they always realize that, hey, maybe there's a better way to structure it. We need to do this to adjust for it. And that's all this is realizing, hey, the government shut down, this XYZ happened. The liquidity that we want in the system isn't there. So let's make this adjustment to it. And again, like you said, it's not getting a ton of press coverage, but it is very important to how markets function to have ample amounts of liquidity at banks without over supplying them with cash or, overly penalizing them for holding cash.
Right. So I think this leads us to what it means for markets. And we've kind of been talking about that throughout the conversation, but generally we view the most recent Fed action as positive for most risk assets, whether, stocks, alternatives, even bonds, this really should be positive for. And I think we should be less focused on the timing of future rate cuts and just acknowledge that this is still an environment of a downward trend in interest rates. We're going to get some form of rate cuts next year, regardless of when that timing is. The trajectory is downward, which is positive for the stock market, positive for the bond market. And I think that's the perspective that we have to take. Of course, as investors, we're going to focus more on the fundamentals than necessarily some of these macro factors. And I don't think we're going to get caught up on the, week to week or month to month of, hey, when is the Fed going to cut necessarily? Of course, it matters as far as timing. But for a long-term investment perspective, we feel good about 2026 from a Federal Reserve impact perspective because of the directionality of rates. And, especially coming off of Powell's press conference, the way that they're thinking about impacting the economy via monetary policy.
Yes. And I think, kind of looking at it and framing it in that way is really helpful. Rates are moving lower. Inflation is on that same downward trajectory. GDP on an upward trajectory. And from a fundamental level, that's all very positive, and should put the economy in a better position going forwards.
Yeah, and I think, and to get into a little bit of our own analysis, I think we will see at least a couple of rate cuts next year. I feel, and we've been talking about this for a while, that the inflation trajectory continues downward. We mentioned that with housing. We mentioned that with tariffs. And I think that's going to have, especially the housing piece, going to have bigger influence than a lot of people anticipate. And so lower inflation will give the Fed more leeway to cut those rates. So I think you're going to be in the 2 to 3 cut range, which is even going to be more benefit those assets that you care about, the stocks in your portfolio.
Yes, absolutely. Thanks, Victor.
Thanks.